9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Yvonne with David Ingles.
We're counting down to the open of markets in Greater China. Let's get to your top stories today. Stocks across the Asia-Pacific are rising as South Korean markets resume trade today, tracking a rally in U.S. chipmakers. Brent, as you can see, now topping $90 a barrel. And as bond yields, of course, surging on fresh uncertainty over the Iran war.
China's economic slowdown deepens, with all major activity gauges falling short of estimates despite a tech-fueled boom in advanced manufacturing.
Speaking of, Unitree Robotics sets the date for its highly anticipated Shanghai debut, and early indications show the stock popping on its first day of trading.
And we'll have more on robots, taking a deep dive into their role in the workplace and their potential impact on the labor market. We're going to hear from RealMan Robotics, which trains machines to work in factories and warehouses just like humans. Well, we finally got that data dump later on in the afternoon yesterday, and it wasn't good, right? And this is before, after, I should say, markets closed. So in some ways, we're going to watch what the stock reaction is going to be. You know, when it comes to renminbi, we saw bond futures didn't do too much, but then there's a lot of lingering questions now. Can this economy actually reach that growth target at the end of this year without any additional stimulus?
Yeah, I mean, what were the one-offs, I think, is the first question.
The weather.
For July. And, were there structural trends underscore the data that might then prompt more aid to come sooner rather than later, right? And I think that's a question for bond markets. I phrase that is, do we get bond yields picking up high in anticipation of more support? Or as we see it right now, we've now taken out to the downside 1.68% on the 10-year yield. So the bond market reaction is quite telling at this point here. Yeah,
and the calls for stimulus are sort of growing. I think, when you have the likes of BNP, I believe they were saying that, it needs 4.3% growth in the second half to reach that growth target. So can we actually get there is certainly one key question. And what form could it actually take here right now? Because when you start to see this pivot in the economy, right, it's really apparent in the data here. And really, when you still have AI and exports still strong, you got to wonder what policymakers are thinking right now.
Yeah, which of the two parts of the economy are, have more weighting in as far as policy prescription is concerned, right? And I think the collapse outside the tech story is becoming more apparent when you look at the data. More entrenched as far as the data is concerned. And, you juxtapose the yields in China's story with everything else that's going on outside, right? And I think it's hard to look at markets just from the prism of China. When you look at bond yields in the U.S., for example, again, the 30-year yield hitting levels we haven't seen since 2007 is the other market story. And I think you put those two things together. And as a policymaker, you had the two biggest economies seemingly on very different footing. What do you do ahead of Jackson Hole? And, of course, as we await, if any, more stimulus coming through out of the Chinese authorities.
Especially when you continue to see AI in credit markets continued in this whole investment boom, fundraising, in a way that is now really to start weighing on the Treasury market, right? You're starting to see that in a big way. So certainly that's still in focus here. We're checking markets, and that return to markets there are opening in Korea. That's certainly one thing to watch out for here today.
Yeah, we're up 2.5%. That's a catch-up trade. It's worth pointing out, though, so this return to Yvonne's point there, this return towards the old winners, like the Nikkei, by the way, in case you missed it, the Nikkei is actually the best performing index globally this August, which underscores this return to what has worked. Gold, by the way, yes, we are closer to 4,500 now in gold. So we're looking at mining stocks as we go into the open today. We're looking at energy stocks as well, energy names on the back of Brent prices, not just 90, we're now trading at 91 on the most active contract there. And, of course, copper has been trading in and around the record level. So, obviously, there's a commodity complex that we are going to sink our teeth into over the next 2 hours or so.
Yeah, let's kind of break down more of the China data that we got yesterday here with the economic slowdown worsening at the start of the second half, right? The boom in tech failed to lift sectors untouched by this global AI build-out. Let's bring in our China correspondent, Mengniu. She's here right now to talk us through the activity data that we got here. How bad was it?
Yeah, it was very bad because every single metric had failed to meet estimates, and the size of the misses were pretty significant as well, particularly when it comes to retail sales. We were expecting an improvement from the previous month, but it deteriorated, and the actual print came in less than half of the forecast. So retail sales just 0.6%. The expectation was 1.5%. So that tells you that domestic demand, that appetite to spend has been very, very weak. Industrial production falling below 5% now. 4.5% is the print for July. So a part of it could be because of the bad weather, the typhoons and the floods, forcing some factories to shut and disrupting shipments as well. But of course, if you peel back the layers and look at the breakdown of different products under industrial production, and you would see that the tech sector is doing very, very well. So things like industrial robots up by 30%, integrated circuits 21%. So double-digit gains there. What else we are seeing, if you look at other things, textiles, chemicals, steel, these are just looking at single-digit gains or even decline. So it's a very clear dichotomy between the tech sector and the non-tech sector, which is collapsing.
Housing numbers also came out. What do we know?
Yeah, so we have the new home prices falling faster than the previous month, and so this is raising doubt about the sustainability of that recovery. Secondary or resale home prices, that is also falling, but at a slower pace compared to the previous month. But you pair this with the property investment data from the activity data yesterday, that was down 19%. That is a record low, a fresh record low. And also you combine this with the credit data that we got over the weekend as well, with people unwilling to take out long-term home loans. It really tells you that, well, it just doesn't make any economic sense, right? Why would you borrow money to spend on an investment on a property that is increasingly being seen as more of a liability than an asset?
Okay, what does this mean for stimulus, right? I mean, it's interesting that, up until now, I think policymakers are saying, as long as we get to that, growth target, even at the low end, it's just enough, right, to do nothing. Have we reached that sort of limit now? And it really is testing that.
Yeah, we have reached that limit because according to some economists' estimates, the July growth is coming in at about 4.1%. And the country needs a 4.3% growth in the second half to meet the full year target. So if this pace continues, more stimulus will be needed, no question. And we did see very fast reaction, at least rhetorically. We heard from Premier Lee at the State Council emphasizing and urging the government to really meet the year's target and to promote private investment, to expand domestic demand. We also have a statement from the Ministry of Commerce earlier this morning just outlining some proposals they have to expand county-level consumption. So increasing the supply of high-quality goods there, helping local businesses improve their branding and innovation. But this is really very incremental measures, right? Nothing of the sort of bold stimulus that we saw maybe in September of 2024. But still, September, a month away, that is potentially another window for more policy fine-tuning. But for now, yes, growing calls for more stimulus. Economists are still quite split about whether there will be a rate cut on the horizon, and that's mainly because liquidity has been pretty ample recently, so perhaps monetary policy is not going to be as effective.
Min, thank you. Min Lo, our China correspondent there on the current state of the Chinese economy through the window, of course, of the data that we got late yesterday. Bond markets are doing this, perhaps in reaction to the soft numbers coming through. We're down just about across the board, more on the short end than we are on the long end, but that's really just academic. We now have a 1.7, 1.68, 1.67 handle on the Chinese 10-year yield. Joining us here in set is Wang Shengzu, Global Head of Asset Management at Haitong International, with an economics background, but you now focus more on markets. So we know the macro has been soft. Is there a new component you think that market participants should be considering at this point, or is this more of what we've seen anyway?
Okay. I think China's economic data in July has been below expectations all across the board.
Okay.
But to me, this is more structural rather than cyclical, because we see the largest drag is still the housing market, and we see that the new house starts and house sales are still in a deep recession, and also including, for example, consumer demand on vehicle sales. Vehicle and housing are the two largest single expenditure items for any household. Okay. Similar even in the U.S. So this is reflect some weak consumer demand, but to me, it's more on the over-investment in the housing market in the previous years, and also the housing market itself is deleveraging, and also resulting in a weak consumer demand. And on the other side, that's some overcapacity, oversupply issue causing the deflation has been lasting so long. So to me, the policymakers, they are in a relatively wait-and-see or modeling through mode. As long as the growth, like Yvonne mentioned, as long as the growth can maintain at the lower end for this year, say 4.5%, they don't want a very drastic stimulus package, given that they also acknowledge it's a more structural issue, and rather than cyclical components of it.
What happens when this sort of K-shaped economy gets very entrenched, right? I think you see it in many economies around the world, but it seems like it's more pronounced in China. I don't know if you feel that way, but what happens when you rely on just one sector to really feel growth now?
Yeah, I think in the short run, just like the correspondent mentioned, people do expect in the third quarter there will be some fiscal and monetary easing on the way because, for example, in the first half of this year, government bond issuance local government bond issuance has been slowing down, and also that's part of the reason that's why fixed asset investment has been slowing down. But we will see something in Q3 or Q4 if growth continue to beat below expectations. But in the longer period, I see it's more on the income distribution and also social security net issue. If you try to boost consumer confidence and consumer demand, for example, we need to continue to increase or improve the social safety net. There's still 1/3 of rural workers that doesn't have enough coverage, for example, on health insurance and social securities. Once you increase the social safety net, that people can be able to spend.
In terms of the China allocations of global investors, would the focus then be mainly fixed income? If it's in equities, would that be mainly industrial and consumer? How do we need to be looking at the portfolio from through the lens of macro?
Yeah, I think for both A-share and H-share Hong Kong market, I think in general the investors favor more on the upper side of the K-shape, which is high-tech stocks, and they underweight, for example, consumer staples and the consumption sectors.
I mean, do you see that in terms of the tech side of things? Can this tech rally broaden out a little bit more beyond just a few crowded names right now?
I believe the government has a strong will to continue this growth model because the government always emphasized just to play down on the growth numbers and also focus more on the high-quality growth. And the high-quality growth means high value added and high-end technology or industrial upgrade. So in terms of both policy support and funding, they are all going to this sector. So I expect that there's continued booming of this one.
Does that also mean we should expect the fundraising environment in the equity markets to continue? I mean, it was a bad year for Hong Kong last year. It seems to be the case even more so. And the Asia market has picked up in terms of fundraising as well. Yeah,
because within onshore, the interest rate has been very low, so the funding cost has been quite favorable. Yeah. And also, there's a policy support by the government to encourage a lot of Chinese firms, in particular technology firms, to go for IPO in Hong Kong market. So I would expect it to continue.
There's still a lot of questions about the monetization of AI in China, in particular, given just the model that and the approach that they have developed AI, right? It's low cost, it's open source. Are you getting more clarity in the earnings on how visible that sort of monetization is now?
I think it's the same issue for China and the U.S. AI monetization. Yeah. It's just in different magnitudes. For example, the U.S. AI firms spends a lot of money in terms of capex, maybe a smaller scale by the Chinese firms, but they will face the same issue, like how to convert this huge AI investment into earnings, which is AI monetization. Because for most analysts, they also try to expect a higher earning growth for these firms. So I think it's the same question for both Chinese and the U.S. firms. It's just different scale.
Okay, Wang Shengzu, you're staying with us from Haitong International. I have plenty more coming up after this break. Still ahead, we're talking about Xiaomi. Shares are set to extend their best quarterly performance in over a year if earnings show it's gotten a handle on those rising memory costs. We have a preview of the results coming up. Plus, we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. Kind of cloudy skies out there right now. Futures are under a little pressure here this morning. You're watching The China Show. Good morning.
Right, welcome back. Chinese currency is a touch weaker over the last 10 seconds or so following the fix, which, by the way, the bias has been tight range if you look at it over maybe, say, a 3-week window, but it's been incrementally stronger given, of course, a strength in the currency. So we're adjusting to the weak side right now on dollar. China goes into the separate story, but still relevant, of course, because of the Treasury story. We woke up this morning to a 30-year U.S. yield at the highest in, let's call it,
2
decades, right? And there doesn't seem to be an end in sight in as far as, well, the debt burden, inflation remains above target, the Fed seems reluctant, and of course you have all the supply that's also coming through in the credit markets, which exacerbates obviously.
And it's not just a Treasury story, right? You're seeing it globally across G10 bond markets, right? When you have German bonds are at 2011 levels as well. JGB yields, of course, we've been talking about those sort of milestones as well. We're back with Wang Shengzu, Global Head of Asset Management at Haitong International. What do you make of this sort of sell-off in the long end of the curve across the world now? Can it continue? What's driving it, you think?
Yeah, I think the main driving force, there are two main driving forces. I think starting from this year, there's 2 new parameters adding to the investment the scope or assumptions. One is the U.S.-Iran war, which push up oil prices, commodity prices, and push up inflation expectations. The second one is the AI investment, AI booms. That's also demand-driven. So also because there's a huge demand for funding in terms to finance this AI investment. So it's not surprising to me that the U.S. Treasury rate yields has continued to rise, given these 2 push factors. There's no pull factors so far. Yeah.
And, we know that the U.S. Treasury Secretary, and I would imagine the U.S. government wants lower yields and lower borrowing costs. Is there something you think that the Fed, is there an opportunity for the Fed to, I guess, in some way tether U.S. yields at the moment?
I see it's quite difficult for Wash. Even the Fed or himself maybe want a accommodative monetary policy, but given the current inflation outlook and also Fed commitment to inflation, and also the U.S. economy is actually doing quite well. Despite the softening, the labor market data, but that's more seasonal on the public sector. But you see most economists forecast the U.S. economy going to be grow around 2.3% or below 2.5% this year. So it's quite decent growth profile. And plus, the AI investment going to boost the U.S. economy by from half to 1 percentage point this year, which is quite dramatic. So given this booming demand, in total demand, it's very hard for the Fed to make rate cuts, in my view. It may delay rate hikes, as many expected in September. Yeah. But if inflation continues to rise and also the U.S. economy is doing well, eventually it's even maybe doing precautionary rate hikes in order to curbing the demand side.
You're still overweight when it comes to U.S. equities. How do you position around this market now?
Right, because in this higher than expected inflation environment, in general, the equities can give the best risk reward. And also given the earning expectation and also the fundamentals of the U.S. corporates, they are doing quite well. So that's why we continue to overweight U.S. equities.
Right. And so stay invested in equities. What about EM? EM's caught somewhat of a decent bid with a softer U.S. dollar that we've seen. How do you think about EM equities at this point?
Right. I think EM equity, in particular Asia, we have been seeing some reallocation from U.S. equities to the Asia space, including Hong Kong market. And given the valuation, we still favor Asian equities, in particular Hong Kong markets.
Wang Shengzu, thank you for spending part of your morning with us. That was the Global Head of Asset Management at Haitong International. Right, Hang Seng Index in the early goings down about a third, down a fifth on A50 futures, and we're zeroed in on the third ticker on your screens, which is this graph, this move lower across the CGB space in terms of yields. Lots more ahead. This is the China Show. Good morning.
All right, at a time when global rates are elevated, we are actually continuing to see the opposite when it comes to the CGB market here after, of course, that disappointing data dump that we got late afternoon. So stocks will react for the first time in just about 5 minutes or so from that activity data, but it was a miss across the board when it came to July. Industrial production, retail sales, and the like was a bit disappointing for the street there. Sectors to watch out for. Gold certainly has been interesting again once now that we have talked about the inflationary concerns and the Fed and really the reduced expectations of rate hikes and the like. Energy is still in focus given the Iran uncertainty out there. We're talking about Geely. There's been some news about the people at the top there. So the chairman, Li Shifu, has resigned. We're also watching BofA, right? Because it just came up with this new, what was this? Music AI agent, I guess you could say. Happy Shrimp.
Happy Shrimp.
So they can basically produce a song
with
just a text prompt with one word. Certainly interesting how that works. A trading debut as well. Shanghai, I don't have press lasers technology, and then of course we're still waiting for some data on FDI.
And speaking of trading debuts, right? We now have a date for the big one.
Yes,
in the onshore
tomorrow.
Markets. Unitree is debuting tomorrow, so watch for that, of course, on the starboard. If I'm not mistaken, there, so that's quite a sizable. I think it garnered what, 8 trillion. Yeah. In retail orders,
nuts.
Right? Not
was it on Hyperliquid was like 4 times
on pricing.
On pricing, certainly a lot of questions, right? I mean, this is first sort of pure play robotics sort of maker in China, so certainly that's one thing to watch. Tomorrow, of course. HS Tech, though, right now we're slightly under pressure here this morning. We have, of course, your agenda. What else to look out for here? Some stocks to watch in focus here today as well. But we are under pressure in Hong Kong today. This is Bloomberg.
All right, welcome back. As we go into the thick of the session today, and obviously we're counting down to the open, and the approach is one that is on the softer side of things. There's the earnings story, there's the macro story, just adding to the density of problems and challenges, really, that investors are having to deal with. And on top of all that, of course, we're still leaning into the AI plays across the region with the likes of Korea coming online today. Japan is paring back a little bit. That's done well. But yeah, a lot remains to be said about what we do with the Chinese markets today, I think.
Yeah, it seems like the implications are, given the bad data, was that, consumption, properties, these are the sectors that might actually react to the disappointing set that we got. The AI trade might still be quite resilient to this because if you look under the hood, right, double-digit gains for a lot of the outputs when it comes to advanced manufacturing, optical receivers, semiconductors, and the like. So that part of the trade still looks pretty strong. So that's why, what you're seeing right now might be that bifurcation once again. You take a look at when it comes to onshore markets. CSI 300 is slightly under pressure. We're flat on the Shanghai Composite. We're slightly, moderately lower for the Chinex as well. We're watching the bond market in particular, right? Look at that 10-year yield. We're at 167 levels now, so we are extending somewhat this rally here beyond just yields that are just at 1-year lows. And then you look at some of the things, right? The bifurcation that we're seeing. Qiao Maotai had a pretty bad day yesterday, right? After their earnings, amid this sort of sluggish demand. I mean, this used to be China's #1 onshore stock. It's now
number 8, I think.
Yeah, 8, and then you got CXMT next to it. That is now the #1. Just goes to show where the market is kind of pivoting too, right? As we see the economy also pivot, right? So the hardware side of things, like CSMC, we're slightly lower here, but Capricorn Tech is actually doing okay. Shanghai crude, once again, is still elevated as we talk about oil markets hovering around that $90 level once again. You flip the boards and look at Hong Kong, right? Of course, we're counting down to not just this, well, in Shanghai, the Unitree IPO. So we'll be doing a lot more on robotics and humanoid robotics later on today, how to train these robots. There's robot schools too, Dave. Also, Alibaba earnings as well that come out. Certainly, and Baidu too. Alibaba's got a slight bid here this morning. It's interesting too because we're talking about this Happy Shrimp 1.0, this new AI model. Where
how does it work? I don't understand how it. What would you need to tell them?
Apparently, a single text prompt can change to a fully produced song. So it really just goes to show this push into generative AI, right? And how these Chinese, software companies and the like are really kind of starting to show this more, the deployment of AI and really the commercialization of it, right? So I don't know how it works. I would love to try it out on live TV.
Would love to try that
Someone
out.
can give us a demo. It's just a beta version out. But certainly, it's helped lifting the stock just a bit. The rest of the space is slightly under pressure. Of course, Baidu, Xiaomi report later on today as well. Offshore RMB is at 674 levels here. Watching the property side of things as well. It's interesting enough. BI has a good report out about the top 10 Asian companies to look out for. Sun Hung Kai is one of their picks in the property space. We'll get more on that from Patrick Wang and his team. Gold stocks are in focus here, of course, as Dave mentioned. We're getting closer to that 4,400, 4,500 level once again. So that's helping the likes of Zijing Gold and the like. Earnings came out from Zijing. I think Citi has a new take on it, saying they were very optimistic when it comes to the superior volume growth that they've seen when it comes to Zijing Gold. The stock up close to 2.5% or more. Chinese bonds, though, you're still watching that very closely, Dave.
Yes, we took out 1.7% coming into this week, and we're now trading at 1.67. No pun intended there. 677. I'm just literally reading out explicitly what the yield is telling me. On that level, which I think underscores really the weak macro.
All the pre-teens that watch Bloomberg are doing the hand thing right now.
Doing the thing, which is also, I think, what bond market investors are trying to do right now. Like, do we trade this higher on expectations of more stimulus coming, or do we lean into the momentum here? Right, that balance. Anyway, okay. Earnings coming out today. You have a couple of big names. You have Xiaomi. We talked about this. Yvonne was mentioning Baidu. China Unicom Giga devices coming out, and Guotai Haitong is on deck today, among others, of course. Now, in terms of implied stock moves ahead of those earnings, and we have a few here that our team has actually run in as far as what the average historical move was post-earnings and what the current set of option settings are implying in terms of the moves ahead. So we're looking at Kuaishou Tech, which I believe is not today. We're looking at 5.1%, and we're looking at previous moves of 6.5% there. Baidu's out today, Xiaomi's out today, and of course, I think HKX is out, if I'm not mistaken, tomorrow.
Yeah.
There we go. But yeah, just keep this in mind. If you do get a big move, don't say we don't tell you so. We didn't tell you so because of what the options market. Anyway, Yvonne, why don't you Xiaomi the next story?
Oh. I'll Xiaomi it to you. Okay, let's talk about Xiaomi, right? They could extend all the dad jokes, 6, 7. A lot going on today. All right, it's a slow news day. Xiaomi shares, though, I mean, they've been on a run, right? They're sending their best quarterly performance in over a year. We'll see how the results turn out. But in this earnings report, it seems to be that it may have gotten a handle when it comes to rising material expenses. Let's bring in our Asia equities reporter, Charlotte Yang. She joins us now. What are we watching out for when it comes to Xiaomi today?
Yeah, so the big thing is how they're handling the rising component costs. So Xiaomi, the smartphone maker, has been one of the biggest casualty among the smartphone makers, from the rising memory chip costs. And that's because Xiaomi has traditionally been selling more of the products that's known for value for money. So what they've been doing in the second quarter is they've been selling more higher priced products, but also working a fine line between how, protecting the profitability while not hurting consumer demand. So for the results, consensus estimate is now expecting smartphone business to decline about 10% and margins to be around 8%. So I think any surprise on that front will be good for investors who have pretty low expectations walking into this. EV is also another big thing to watch. They did have over 550,000 targets units for this year, but the first half they've only achieved around a third of that. So they will be keeping an eye on how they can ramp up the capacity and also how they plan to have the execution to live up to that.
And suffice to say, positioning then, going into the results, looks like what?
Yeah, so it's actually a pretty low bar for Xiaomi to impress, given it has been seeing continued earnings downgrades this year. And also, bearish positioning has come down a little bit, but still pretty elevated, which says that, if we actually did any, upside beat in terms of the profitability, you could see some short covering on that front as well. And the stock has been, rebounding. This quarter has come up around 20%, ending 4 quarters of decline. So I think if we actually did better than expected result, that could continue to extend the momentum.
Thank you so much, Charlotte Yang, our Asia equities report ahead of these Xiaomi earnings. Also coming through this time tomorrow is the big one, the big listing, or the biggest one yet so far. Unitree Robotics, much anticipated trading debut in Shanghai that is now set for Wednesday. Let's bring in Balazs Pens, our Asia Equities Deputy Managing Editor, here with us on set to talk us through this. So here we are. We now have a date, and we know this is much anticipated, much in demand. What do we know ahead of tomorrow?
Well, we know that the retail portion of the IPO was wildly oversubscribed. It was over 5,000 times the order book. The order book itself, the retail order book, was bigger than CXMT. That just shows you the excitement around this company, which will be the first pure-play humanoid robot stock on the market anywhere in the world. We've been tracking some derivatives, CFDs, which indicate the pop on the first day could be over 300%. As you might remember, CXMT popped more than 400% on the first day. Whether they can hold on to those gains is a different question, but there's a lot of excitement. There's a good chance that this will be very active, very positive from the get-go. Part of the reason is that we saw some research from JP Morgan which suggests that the market from humanoid robots, remember, Unitree shipped just a bit over 5,000 units last year. JP Morgan thinks this market could be over 1.5 million units by 2030. So we are at the very beginning of the cycle for humanoid robots, and Unitree is the first chance to buy into that.
We've been talking about just the fact that, Qiao Multi used to be the number one, in terms of market value in mainland, and now things have, changed to more CXMT, right? The hardware side of things and China's rise in that sort of industry. I think Unitree is kind of part of that story, this pivot in the economy that we're seeing, where this is the next big thing for markets really now.
Definitely. Unitree is a little different from CXMT in that CXMT is kind of the culmination of a lot of different hardware makers, especially memory chip makers. That's a known market. We have huge companies on that market already active that CXMT is competing with. Yeah. Unitree is at the bleeding edge of this technology. They're the first. They're the very first ones to the market, and that gives people a little bit of a different feeling, a little bit of a different sense. This is much more a bet on the future.
Okay, Balazs, thank you. Balazs Pens there, our Asia Equities Deputy Managing Editor. On what to expect out of Unitree tomorrow. Of course, we all bring you the latest there from Shanghai. Coming up, from AI to automakers, Bloomberg Intelligence has crunched up a new list of the top 10 Asia companies to watch out for the rest of this year. This is the 10 that we have here right now in the region. We'll have more on some of those picks here coming up. This is Bloomberg.
Okay, so did you make the top 10? I sound like Ryan Seacrest on American Idol. No, so this is the BI list of the 10 APAC. So I dated myself just now.
You totally did.
The APAC companies to watch across the Asia Pacific, the inaugural list across the region. Have a look at those logos. It's a fantastic piece, of course, in the terminal for our clients to look at here and why we pick these. Everything from AI autos to property in Hong Kong, of course. One to watch is Sun Kai, which is the developer, and in mainland China you have milk brand Mengniu making the list.
Yeah, let's kind of narrow down some of them, right? Especially the ones that are listed in Hong Kong and China as well. And bring in our team from Bloomberg Intelligence. Patrick Wang is our senior analyst for APAC Real Estate. Elaine Lai is also our China consumer analyst. Patrick, I'll start with you. Sun Kai, You're saying continues to rank number one when it comes to the Hong Kong residential sales in the first half. Tell us a little bit more about why you chose this, and how do you think it's going to impact its earnings growth?
For Sun Hung Kai, it's always have the largest land bank in Hong Kong over the past decade. And then for now, they have several new projects upcoming in the pipeline in the Lofton Metropolis. So that is also up and running, the development there. And also for the luxury residential apartments in the urban district, they still have quite a lot of unsold inventory that's still getting more and more demand, right? And I think it's the overall prospect is also fantastic in terms of the earnings growth, that we have the target 30 billion that the company gave us like for the full year until June. And that is also 27% beating based on our latest estimate. So we see that its upcoming earnings in September, that will also be a positive earnings growth trajectory and also support the overall situation.
I mean, the housing market has rebounded exceptionally well. Maybe the last month or so has been consolidation. So where do you think house prices go, and how does that affect then this company's strategy?
Yeah, we have the BI forecast model for the home price. And then for this year, we are expecting 11% growth and then another 7% for next year.
Wow.
I think so far it's on track. Of course, there's also some concern about like the mainland buyer softening a little bit recently. Still, we are also expecting the situation that the price growth support the development margin for Sun Hung Kai. So that's also a positive outlook for the earnings.
Yeah, tell us a bit more about that, right? This sort of crackdown we've seen on taxes, right? 20% tax on rental income, capital gains from the Chinese government. How do you think it's going to impact the demand from the mainland moving forward, you think?
I think it depends on the enforcement. Of course, we also now seeing the situation like recently we have the like insurance is also another thing that the government targeting. And then property depends. I think really situation is always about like how they deal with the overall soft property buying situation. Having said that, I think the enforcement is still not very easy because there is also lots of like the corporate buyers. There's also the situation that how they track about the mainland Chinese buying in Hong Kong, right?
Yeah.
So it's not easy to figure out like the situation to enforce this taxation. So overall, may not have a really sizable impact in the long term. Short term, I think there's also some sentiment have some impact overall. So the volume slowed down like 40% recently, but again, as what we just discussed, the price up a lot. So yeah, it's kind of like stabilizing at this point.
Yeah.
Speaking of up a lot, I mean, the share price of the other company in the list is Mengniu. Share price is up, I think, 20% this year. I mean, we have results coming out. Like, I guess first, why this company? What's special about Mengniu, Helen?
Well, Mengniu is the second largest dairy producer in China. It's also one of the top 10 globally. So it's always like a bellwether stock for the consumer demand. Looking into the result, I think investors will be watching very closely on the sales momentum, whether this company is able to revive its revenue growth. It's been quite weak for the last 2 to 3 years. I do think that for this first half result, we're going to see sales accelerate on a headline basis, but that is not to say that we are concluding there is a substantial recovery because this company is lapping over a low base prior year. And also because the company has made a lot of progress in clearing the excess inventory in the sales channel. I think the dairy sector as a whole is still struggling with oversupply situation. Remember back in 2008, we had a melamine crisis that had got like a tainted milk issue that hurt a lot of people. In response to that, the regulators have been pushing for investments in large-scale farms and also to improve the food safety standard. So that many years of investments have resulted in oversupply today. And now across the entire sector, brands are competing almost entirely on price. The products are quite undifferentiated.
Yeah, and beyond just the near-term numbers, right? The longer-term trend is that people are having less babies, right? The birth rate isn't really in their favor here right now in China. So how does a company like Mengniu find its next source of growth?
Well, demographics is one of the reasons for the depressed demand, but that's not the whole story, right? I think there's something very specific in the Chinese context. So in the Chinese dairy market, majority of the industry revenues coming from room temperature packaged milk that are sold in tiny paper cartons, right? So that is very different from what we have in the Western markets where there's a diverse range of products, like you have cheese, you have yogurt and everything else. So consumers today, they are consuming less, but they're consuming better. They are shifting to chilled fresh milk and other non-milk dairy products as well. Mengniu is pivoting to that diversification. But then if you look at the revenue structure of this company, 70 to 80% of that is still coming from the basic pasteurized milk. So it's going to take time for the company to make a significant pivot to the new products.
What about new markets? And it's perhaps looking to sell more of its products outside of China and abroad?
Yes, of course. I think Southeast Asia is definitely standing out as a bright spot. Chinese companies generally would have an edge in that region because if you look at the demographics, it's much younger, and also in terms of the average income, purchasing power, I think a lot of the markets in Southeast Asia is actually quite similar to the Tier 3, Tier 4 cities and even rural areas in China. So Chinese companies still have an edge in understanding the consumer profiles. That's why Mengniu is actually the top player in ice cream in the Philippines, in Indonesia, in Vietnam. Is doing really well. But of course, not every overseas move is a successful story. Right? During the boom years, Mengniu has made some acquisitions that turn out to be below expectations. But I would say that in the recent years, the company has got more discipline in that sense.
Okay. Does that help with margins? Because obviously there's a lot of oil-driven sort of inflation that's really impacting their supply chain.
Well, what's interesting is that I think Mengniu and a lot of the other dairy companies, they are relatively insulated from the oil price shock. Because oil price pushed up the PET costs, but the main input for Mengniu is milk, and milk price has been falling in China for more than 3 years already.
Okay.
But then again, marketing costs is going to pressure the operating margins for this company for this year. Understanding that this company is a major sponsor for the World Cup and the Winter Olympics.
All right.
Really good context.
I learned so much about milk.
I know.
Thank you.
I didn't know I needed that today, but I now do more than the calcium.
I mean, I agree though. Like room temperature prepackaged milk doesn't really sell me, right? I always like my milk chilled.
No one wakes up in the morning wanting exactly phrasing it in their head.
Or just ice cream. I mean, I'll just go straight to ice cream. Why not?
Oh,
yeah.
Anytime of the day. Fantastic team. That was the Bloomberg Intelligence team right there, of course. Our consumer analyst, Elaine Lai, and our senior analyst for APAC Real Estate, Patrick Wang there. For our subscribers, you can check out the full list on the BI's companies to watch in the region on the terminal and also on Bloomberg.com. Check it out now. This is The China Show.
In some corporate news this morning, Bloomberg has learned that Alphabet is looking to raise about $3.6 billion in what would be its debut bond offering in Australia. Sources say initial price guidance may come as early as Tuesday, with the notes potentially pricing the following day. The company may sell securities across 4 maturities, including one as long as 20 years. NVIDIA will spend as much as $105 billion to support a massive new data center in Ohio that's set to be leased by OpenAI. The ChatGPT maker will secure around 8 gigawatts of computing capacity from the complex, with the first 800 megawatts expected online by 2028. The deal marks the latest tie-up between 2 dominant forces driving the AI boom. Fast fashion retailer Shein is said to be targeting a valuation of up to $27 billion in its IPO in Hong Kong. Now, that's below an earlier target of $30 billion. Sources tell Bloomberg the company will seek to raise about $2 billion, with existing shareholders possibly taking up about half of that offering.
Okay, well, the trading debut today we're looking at is on the mainland, and this is a company that makes, judging by the name, you can sort of make that out, precision lasers, and we're up 550% on that name on the debut today, and that's ahead, of course, of tomorrow's Unitree debut, and of course that's something we'll be talking about. Let's save that for tomorrow, but for today, of course, fantastic debut. They were up by $1,000 there from, just do the math there, from about 200 or so. Copper stocks also in focus here, given, of course, the continued steady but consistent march higher in copper prices over the last several weeks or so. We have been pulling back as far as the equity complex is concerned, given, of course, the catch-up trade we've seen there already up until a few days ago, 14.1 right now on the LME contract on copper. China dashboard is looking like this when you look across the equity complex, and I think the iteration of the macro slowdown is coming to you in the form of bond yields just about across the board. Bottom of your screens, 1, 10, and 30. As you can see, we're down across the board. Equity markets are coming under pressure, not a lot. Let's just call this a marginally down day. On the Hang Seng Index, we're down about 0.6% here.
Yeah, interesting enough, you're seeing HS Tech actually, the initial rally that we saw, or at least what we saw the get-go about 20 minutes ago, we're fading now. And really what's driving that is this consumer tech play. So I got to wonder, is the weaker numbers that we got in July and the activity data, is that weighing on that side of the business and that sort of theme here today? So certainly that's one thing to watch as we continue to watch these markets. And you're starting to hear more of these banks talk a little bit more about the lingering concerns now, rising concerns that whether China can actually reach its growth target by the end of this year without additional stimulus, right? Larry Hu from Macquarie did say, right, this sort of just enough rule is being tested now. But no more, he says, right? So there is now maybe more signs that they need to do more fiscal sort of stimulus there. We're going to talk a little more with Helen Qiao from BofA here in the next hour about the data as well. She, of course, is the Global Research Chief Greater China economist. She joins us in just a few minutes. We'll have a lot more on the way. In the next hour, you're watching The China Show. Welcome back to the China Show. Look at the CSI 300 half hour into the session, and we are seeing a bit of a pressure onshore here this morning, offshore markets as well. This is, of course, after that disappointing data that we got out of July that came out late yesterday, right? So they postponed that data release to 3 p.m. On Monday. So this is the first time for really stock traders to react to this, and really it was a disappointment across the board. We look at industrial production, you look at retail sales, fixed asset investment, which all missed estimates. So certainly that's one thing to watch here today, Dave, but what else are you looking at? What's caught your eye? Yeah, well,
what was actionable, right? And as far as from a policy perspective, I think when the numbers broke, what was one-off because of the weather, what was to the point that our earlier guest made. Structural, and that, needless to say, is that actually actionable at this point in time, and what was more cyclical, and as far as more front-loaded fiscal spending, could be the solution. I think today the market iteration of that is when you look at some of the consumer names, there is, of course, an earnings component too, and you are getting a very steep sell-off across. Yes, you have the AI names that have been driven up substantially, but you have your large cap platform consumer-facing companies that are really at the very center of the cyclical story there, like Meituan, and you have JD.com down about 2.8%. Hang Seng Tech, it's also worth pointing out, it did have a really good day on Monday, so maybe we're just reversing most of those gains today. Speaking of catching up is the Kospi Index, which is resuming trade today against the backdrop of a really softer Asian equity complex, as you can see on your screens. A lot of the big tech movers across the region here, SoftBank, Samsung, Nanya Tech, which is, of course, the Taiwan complex, and SK Hynix also coming out and rounding up, of course, our glance at the big tech plays across the region today. Very quickly, the bond markets, we woke up to a 30-year at the highest level on yield since 2007 on the long end, and this is where we are as far as the 10-year. The Japanese 10-year and Oz are all playing some catch-up there to what happened, of course, overnight. Commodities, gold, silver, after 2 days of gains in gold, we are at these levels at 44. And yeah, obviously given the stories in Iran, and of course 91 on Brent, Shanghai's doing that, of course, is something to consider, given the inflation equation that we're trying to balance here. Yeah, let's bring in our managing editor for Asia Equities, Lianting, too. She joins us now. Lianting, take a look at what happened to the U.S. 30-year yield, right? When we're talking about the highest levels in 20 years, is the biggest risk to this whole AI fuel stock rally now higher interest rates?
Yeah, it certainly could be. Globally, big tech is spending hundreds of billions of dollars on AI infrastructure, and companies are increasingly turning to debt to fund those investments. So that makes them more vulnerable to higher bond yields. As you mentioned, the 30-year yield at the highest since 2007, and that is becoming a bigger consideration for investors right now. The good news, though, is that stronger earnings for these companies are helping to offset that pressure somewhat. The hyperscalers still have healthy balance sheets and very strong profit growth. So the market is willing to look through some of the concerns about the rising interest rates. And coming back to Asia, for Asian equities, rising yields is definitely something people are watching out for. Some are even talking about 5% yield for the 10-year Treasury being a danger zone for equities. But for Asia, I would say a weaker dollar right now is helping offset that impact a little bit. So investors are saying that Asia for now is somewhat insulated.
I mean, earnings are somewhat maybe providing some of that insulation. I think, we're in the thick of earnings season here, Lianting, and I think when you look at some of the markets, I guess outside Greater China, for example, have rallied quite substantially. Are we getting that earnings support to justify, I guess in some ways, what was in past tense a really strong rally since the start of the year?
Yeah, exactly. If you just look at today in Australia, BHP and CSL both did so well. To answer your question, yes, the fundamentals are looking increasingly supportive. Earnings estimates for MSCI Asia Pacific Index have jumped almost 10% since the end of June, the biggest upgrade for that period since 2009. And this isn't just analysts becoming more optimistic. Companies reporting their latest results actually have beaten expectations by an aggregate of 31%. And next week, we'll see the biggest or the busiest week for this earnings season. So we'll see how that plays out. But overall, that earnings momentum has been quite important for Korea and Taiwan because they have had a huge run this year. So if that momentum sustains, and that would suggest that the rally has a stronger foundation, which could mean that investors may come back to those markets after a big deleveraging that we saw in July.
Lianting, thank you so much. Lianting, too, with the state of markets right now, what we're tracking at this point. In the trading session, just ahead here in shows, we're talking about the Chinese economy and the numbers that came out yesterday, soft numbers just about across the board. With BofA Global Research Chief Greater China economist Helen Qiao joining us in a couple of minutes to break down the numbers and what it perhaps means for policy implications moving forward. That's coming up next. This is Bloomberg.
China's economic data in July has been below expectations across the board.
Okay.
But to me, this is more structural rather than cyclical because we see the largest drag is still the housing market, and we see that the new house starts and house sales are still in a deep recession. The policymakers, they are in a relatively wait-and-see or modeling through mode.
Yeah, that was Wang Shengzu, who joined us on shows earlier, about an hour back from Haitong there, about, well, his take on the latest economic numbers. Part of it was, he says, structural. In case you missed the data release, which originally, of course, tends to be released 10 a.m. local time every month, had an afternoon release yesterday. That's what you had in yellow coming from the prior read, and I think you don't have the estimates on your screens, but they missed pretty much across the board. We're looking underneath the hood in as far as industrial production and data is concerned, right? So while the headline did miss, there were bright spots. Industrial robots, as you can see, are up 30% year to date, year on year for July, up 30%. NEVs were up 30%, but some of your sort of OG
electronics,
yes,
and the like is double-digit losses, right? So it just goes to show this K-shaped economy, right? And really how entrenched we are at the moment. And it's interesting what Larry Hu from Macquarie said, right? That this whole just enough sort of approach that policymakers have taken up until recently, is that now being tested now? Are these numbers actually soft enough to prompt some additional stimulus? And can we actually hit that growth target this year? Lots of questions to unpack with Helen Qiao, Chief Greater China Economist at BofA Global Research. Yeah, are you concerned about whether the economy can reach that growth target now by the end of this year?
Yeah, well, the target is supposed to be a range, right? 4.5 to 5%. This is the first year that they lowered it and changed it into a range. I think the lower bound of 4.5% is reachable, but it's not like without any effort. At the moment, I think the biggest trouble is not necessarily the current level of growth in third quarter, but actually the sequential momentum. If you look at Q2, it was quite a step down compared to Q1. In sequential terms, from a 4 handle to a 3 handle after annualization, seasonal adjustment is only 3.6%. And now, if you look at the July numbers, it implies that this momentum continued into third quarter. While there was a low base from a year ago, Q3 last year was pretty low, I don't necessarily think that this can really let us just chill out and relax and think that 4.5% is so reachable without any effort. We still need to do more. Otherwise, without stabilization, I think against especially a higher base in Q4, this full year is still going to be quite a challenge for that 4.5% to be reached without any policy stimulus. But that said, we think that policymakers are probably just becoming a little bit more data dependent. They haven't decided to pull out the bazooka yet.
So at this point, what policy scenarios should we start considering that we perhaps weren't late last week?
Well, at the moment, I think we're still staying in a state where, unfortunately, that the export strength is more than, well, I wouldn't say more than, but partially offsets some of the downward pressure from the domestic demand side. And therefore, policymakers are thinking, this year is a challenging year, but it's okay. Everything is still going to be in that range, and we don't have to do much more. But we think that there is a scenario, at least in the second half, if, let's say, exports decelerates more notably, and then policymakers will probably be more seeing, at least a higher level of urgency in terms of rolling out more stepping up measures in policy easing. And we think it's very much warranted. We don't think this is necessarily structural. There is a big cyclical element in it, and policymakers need to do more.
And what form could that additional stimulus take, right? Does it mean more fiscal spending? I think some of these local government quotas haven't been really met yet. So there's still some space there. People still talk about when it comes to subsidies, when it comes to the services sector. I mean, what form do you think is appropriate now?
Fiscal is probably very important, but at the same time, I would say that monetary, is probably also necessary in the sense that this sends a very important signal. At the moment, without interest rate cut, without triple R cut, everybody is basically saying that, okay, you know what, policymakers may be pretty comfortable with where the growth is, even if it decelerates further. As long as the AI sector, computer sector still, advances, we're okay. I think such expectations is concerning because without the expectation of potentially policy easing stepping up, people would not necessarily automatically become more confident about consumption, about investment, and then turn around with their behavioral, decisions, right? And therefore, we think that they need to do more and send a strong signal. But at the same time, obviously, I think fiscal, as you said, Yvonne, I think is the key here. At the moment, households are very stingy about consumption, as we saw in the retail sales numbers. And, the subsidy programs were probably running out of steam, especially when it comes to home appliances and autos. It's okay with the cell phone and pads, but, that's too small to matter. And at the same time, investment is in bigger trouble because not only manufacturing investment growth posts negative growth, but if you look at infrastructure investment, that's actually becoming the second largest drag. So we do need to see more policy action.
Yeah, well, so why has momentum slowed so much? It's a two-part question. Why and what part of that can we blame on the friction on fiscal expenditure? Like, why has fiscal spending lagged quite a bit? And, does that pick up as easily as we've seen that lag, I think is my question.
First of all, you're absolutely right. It is the fiscal that really turns the dial from Q1 to Q2. In Q1, we saw, quite significant boost coming from the fiscal side. Infrastructure investment was pretty resilient, and FAI growth as a result turned back into positive territory. Only 1.6%, but still positive. But then in Q2, we saw that fiscal expenditure pace has slowed quite notably. But this is probably because, in our view, that the fiscal revenue has also slowed. So without changing the fiscal deficit, your revenue slows down. What can you do, especially on the local government level? You can only slow down your expenditure. Local government expenditure is about 80 to 90% of overall fiscal expenditure in China. So if they slow down, even if central government is spending much faster, it doesn't really change the bigger picture too much. So now I think local government financing is the biggest part that is contributing to the recent deceleration.
I see.
So what's the right window for maybe some sort of policy signal? People are saying September, right? It brings us back to what we saw in 2024, where they did this whole policy pivot. How soon could we see, you think, any sort of announcement?
Well, compared to back then, Yvonne, the issue is that exports is still much stronger. Back then, it was 5.5% for the year, right? We're talking about this year, at least a 15, if not 20. But under such circumstances, will policymakers immediately feel that we need to roll out something to actually turn it around? We think that the hurdle hasn't been reached yet. But the good news is that I think the complacency level has already declined. And because from April to July, all these numbers continue to get worse, I think that there is more attention paid on growth. And therefore, I think there is a higher probability that we could see more policy reactions. But is it in the same fashion as what we saw back in September 2024? I think it's hard to tell, because especially back then, there were some other than the fact that the export were not as strong as back here. But at the same time, I think there was also the surprise factor from local governments in deterioration back then, which is gone this time. They kind of been bad for a while. So would that really trigger a shock and awe kind of, it is so bad, let's do something? Probably not.
People have been, I just want to make the comparison with what we're seeing in the U.S. People have been comparing the large U.S. tech companies raising a lot of money in the debt markets, acting almost as fiscal stimulus to the U.S. economy. We're now seeing a lot of the Chinese tech companies raising vast amounts of money in the equity markets, perhaps less visibly, but still active in the debt markets. When do you think that then feeds into the capex, the private capex number, which I think you alluded to earlier?
It probably does, but the problem is that, David, that the share is too low, and therefore, even if that they are borrowing like crazy and the pace of growth is very notable, unfortunately, when you multiply the two, the contribution to headline fixed asset investment is still pretty.
Rounding error.
I would say minimum.
Okay.
Yes. It is growing, and we think that it will be by 2030 growing to a more notable area. But compared to the existing overall FAI portfolio, it is too small to matter. So that's one. But at the same time, I would say that China right now, if you look at the money and credit data from last week, I think it's pretty much showing that it was the public sector or the government that is doing most of the heavy lifting. The households and corporate loan numbers, right, have been contracting from a total loan number perspective. So new loans are negative. So this is because that they don't have the confidence to keep investing, and therefore we need to see some messages out there to encourage people into investment.
What about inflation? I think we're starting to see some of that initial oil shock to inflation. I mean, that really starts to fade now. I mean, is there a risk that China falls back into deflation now?
Yes, I think such a threat is very real. And if you look at the most recent one, coming back already from a 1% level to about back to 0.5% level in year-on-year terms, a sequential turn, also much softer than before. I think that again highlights the fact that compared to the more resilient supply side, demand side, especially domestic demand, unfortunately has been too weak. And when you see still a fairly large gap between the two, CPI inflation is going to tell us that it is not going to rise further. So PPI inflation, in our view, has already peaked out from 4.3% in June, and recently a 3 handle and probably back into 2s. And CPI inflation will struggle to get back towards the 1% level. We see that probably it would range somewhere between 0 to 0.5.
I'm getting more depressed, actually, with the tone. So apart from exports, what else is doing well?
Export is the most notable, and also I would say the derivatives, as you said, related to AI development.
Sure,
because those models are not necessarily all for export, right? But they also benefit. I think those are the highlights. But I think it's a little bit risky to call it K-shaped because you have a very narrow kind of
a very small arm
sectors.
of the K.
Yeah. Exactly. The arm is actually pretty thin, right? But then the leg is extremely long and thick. And at the moment, I think that we're still seeing predominantly the growth deceleration in most sectors.
Yeah, it's like a T-Rex. If you imagine the...
Oh, that's a good one.
Right?
Small arms.
Small arms.
T-Rex. Helen Qiao, fantastic as always. Thank you so much for their take there in the breakdown of the numbers coming through. Chief Greater China Economist at BofA Global Research. Coming up here on shows, we will be, as we alluded to there, of course, one of the bright spots really is robotics. And we're actually speaking to a company that actually trains robots maybe to be more like humans. So we're taking, we're headed to class. We're going to school. Coming up next, this is the China Show. Shares of BHP up 3%, roughly, slightly off session highs, but where we effectively have been trading anyway. Outperforming today, given, of course, the profit numbers that came out from the company.
Yeah, good numbers. Of course, record copper prices certainly is helping the likes of BHP. I think shareholders also got a pretty hefty sort of dividend. They called it a dividend bonanza as well. So certainly some payouts coming through here as well. Let's bring in our Asia Trade co-anchor, Heidi Stroud-Watts. She joins us from Melbourne, and really a big interview coming up, of course, with BHP. Just walk us through some of the results and what stood out to you, Heidi.
Yeah, really very, very good numbers, right? And you can see that being reflected in the investor optimism, which hasn't sort of quite been the way going into this earnings release, but we'll get to that in just more of a moment. But I thought it was interesting listening to you guys talk through, just how consistently unimpressive the China data is, just this picture of that continued slowdown, particularly in the industrial and property and these sort of old economy sectors. And you can see a company like BHP being a direct barometer of that, right? For the very first time, the commodities breakdown, if you take a look at the mix, we're seeing more revenue being derived from the copper side of the business than iron ore. We know that iron ore basically topped out back in May at around 112 tons, and it's really come down pretty steadily since then as a result of that diminished demand from steelmaking in China. But copper is a very different story. We've talked at length about, the squeeze, the surge in US shipments, the concerns about potential tariffs coming through. So all of that is that growth opportunity that has, to an extent, been captured by BHP. And we heard it from Brendan Craig earlier today. He's saying that copper is really the engine of growth here. We see so much enthusiasm for it, and they actually see on a global basis demand surging to 50 million tonnes by the time we get to 2050 from 34 at the moment.
And, Heidi, as they lean into, I guess, that part of the business, which is copper, and the doubling down, I think, is the framing there. But how does that then sort of inform us about the outlook here as far as investors go?
Well, it's interesting. We came in, Dave, into this set of earnings with the lowest buy ratings for BHP ever, right? 4 out of 30 analysts that we surveyed here at Bloomberg have a buy rating. The likes of CLSA, Citigroup, for example, over the past year have reduced their buy ratings on this company. And a lot of it is really to do with the growth potential in the copper business. M&A in copper has been quite difficult. We saw that failed attempt for Anglo American, for example. So there's a lot of question as to whether they're going to be able to adequately capture this opportunity. The demand demand is there, but what about the assets? Because we know there are declining copper grades at the South America mines, the Chile mines, for example. So where are they going to get that exposure? So that's going to be one of the big topics for Brendan Craig. Remember, he's only been in the job for like a month, right? So essentially, he's looking through these earnings of a full year where he wasn't in charge. So the question is going to be, what is his strategy? Is it continuity? Is it going to be more aggressively pursuing M&A? He said that the bar for M&A, particularly for copper, is very, very high. Well, where else is that sort of organic growth going to come from? There'll be questions about the iron ore side of things as well. They were also present at that roundtable with President Trump on critical minerals. So it'll be really good to get some insight into what those partnerships and opportunities might present as well. And look, iron ore remains a very core part of its business, right? The shipments, the production has been pretty close to record highs. So there is still optimism there, but it is clearly not the bedrock that it's been for the last 20 years.
All right, Heidi, more info from you, of course, coming up. Heidi Stroud-Watts there, our Bloomberg Asia trade co-anchor, of course, and that interview with BHP CEO Brendan Craig will be coming up. Speaking to Bloomberg first about the results and outlook, he will join us on Insight there in the next hour. More ahead on the China Show.
Right, welcome back. So, the Asia Pacific has really been home to world-beating equity markets, and I think on your screens is the #1 index this month, which is the Nikkei 225. That's globally. We're down 1.6% as we go into the lunch break there. In Tokyo, certainly the story has been really more on the macro side, not so much the FX markets, but this melt up we're continuing to see on the 10-year yield. And before you know it, we're a bad day away from hitting the 3% handle on the 10-year yield. And it's unsurprising given, of course, the melt down we're seeing in value on the long end globally on global treasury markets. That's the story for Japan today. From one world-leading market to another, which is the Kospi and the Korean index, which, of course, year-to-date has really been one of the standouts. And so far did okay at the open. I believe has now completely erased its gains from the open. And we're now down about a fifth of 1% there on the benchmark. As you can see, we're also below that 7,000 handle on the Kospi index. Okay, we can table that for now. This time tomorrow, one of the stories I guarantee you we will be talking about is this trading debut, much awaited one, of Unitree in mainland China. The company will start trading on Wednesday. That's the new information we have from late last night. The IPO, in case you missed it, drew massive demand from retail investors, and that portion of shares more than 5,000 times subscribed. So the company eventually raised about $904, that's $1 million, in that listing, and is set to become China's first publicly traded humanoid robot maker. Yvonne.
Yeah, I wish we had some sort of live pictures and what are they going to do? They got to bring the robots on stage, right? And
they do.
Perform in some way, right? We saw in the Spring Festival that they brought all these dancing robots out. I want to see one that can maybe, bang a gong or something.
Bang the gong,
right?
yeah.
It's interesting, right? When you talk about this whole humanoid robot industry, and really China dominates, right? This report that came out last week that found that China's humanoid robot makers are commanding more than, look at this pie chart says it all, more than 97% of global shipments in the first half of 2026. So that's according to industry data from Smart Analytics Global. And according to their calculations, Shanghai-based Agibot had the top spot. Now, the company had 44% of those global shipments. That is some 8,400 units in just the first half alone. One industry group also estimates that China installed 300,000 robots back in 2024, and that vastly outnumbers the around 38,000 machines that were installed in the U.S. last year. This one on your screen, that you're looking at right now, was being tested for its real-world abilities at last year's World Humanoid Robot Games in Beijing. And I think we spoke to Jesse Liu from Limex yesterday, right, about what is going to be the key theme at this conference this year in Beijing. He says it's really about moving some of these robots into the real world, into the open space environment.
Physical AI, right? And it's not even close when you look at how far China's actually come on many of these fronts. And specifically, of course, when it comes to robots, and of course, really the upgrades that we then need to see and should come to expect, I think, in terms of the capacities of robots. And I think also interesting is, I mean, people talk about this as a zero-sum game. To what extent will robots replace humans? I think that is a question anyway that has somewhat been answered, and not just this time, right? You look back at the course of how manufacturing has been automated the last 120 years. I mean, there has been this takeover of robots on the industrial side. And I think moving forward, I think in the physical and in the retail front, what will the relationship be between robots and humans? And by the way, that is not a philosophical question. That is more pragmatic and practical at this point in time. Let's bring in Kenneth Ren. He's the Director of Overseas Solutions at RealMan Robotics. It's a Chinese embodied AI firm that actually runs a humanoid robot data training center in Beijing. Kenneth, good morning. Thank you for joining us on the shows. Why don't we start with that? What is the question that you guys get from the industry and your community and your clients between, the future relationship between robots and people? Let's start there.
Okay, for the robot and the human workers, we think that the robot cannot replace the human workers, or maybe the human workers will not lose their jobs. Because why we develop or why we design the robot, we want the robot to really help people, help human workers do something in the real task, not replace the human workers. And for example, we think that the robot can help human workers to do what the people don't want to do or what the people cannot do, even in some dangerous scenarios. And to be honest, we think that in the near future, the robot cannot replace or cannot control the whole task independently without humans. So maybe we need to have a human and robot collaborations. For example, the robot do some standardized task, and the human do some like the judgment, like some high-risk decisions. And I think that is why we use the GLN or we use the teleoperation devices, because we think that use teleoperation devices, we can control the robot in anywhere remotely. And on the other hand, we think that, when we use the teleoperations devices or when we use the robot, some roles will be created. For example, we need some human workers help us to control the teleoperation devices, and we need someone to help us to do some data collections. So it means that the work will not be replaced. They just change the word from the direct control to the maybe managing. So that is what we think, that not replace the human workers.
Yeah, can you just walk me through what it looks like in these robot schools that you have? What does it take to train a robot, for one thing? And I know it could be a pretty costly sort of operation, but I'm guessing you need a tremendous amount of training data. Is there enough of that training data out there now?
Yes, more and more company has launched the different type of the robot. So it means that the robot has maybe beyond from the lab or some simulation environment to the real world environment. So maybe first about the robot training platform, we think maybe next generation of the training platform will focus on, for example, like factory, like warehouse, or even some service environment. And we don't want to teach the robot to do some 1 or 2 or 3 specific action. We want the robot maybe can identify, even adapt to the different task or different environment, even some unexpected situations. And that's why we think there's maybe 3 steps or 3 stages of the robot training or robot features. First is about to use some teleoperation devices to control the robot. For example, put a bottle of water on the table or do some window cleanings. Although maybe it will use the 5 minutes or 10 minutes, but when we moved to the second stage, that is, we will collect some data during this process, or maybe we can know the details of each actions, and we can continue to move the third stage, that will to train the mode of the robot by this newly collected data. So it means in the future, when we have more and more data or when we have more and more details, the robot will be more and more quickly, maybe from the 5 minutes to 3 minutes to 1 minute, even 30 seconds. And we think the long-term goal is that the robot can planning or making some decision by themselves. That is what we want.
Oh, okay. So, I mean, riddle me this. So in a year's time, because you're very close to the data and what robots are capable of doing, and I think part of what you guys do is upgrading that skill set, what would be the most advanced thing a robot you think would be capable of in a year's time?
You mean what the robot will really do, right? In the near future, we think that, for example, do some highly standardized task or do some high repetitive task. For example, moving the box, and sometimes we have some problem. For example, like night shift demand, or for example, like some labor shortage problem. I think that is the robot can do in the near future, because they can really help humans to solve these problems, not to replace the human workers.
Okay. Now, I want to get a sense of the scale of your business, given that this is a booming industry. It's also a policy priority in mainland China. Talk to us about your industry. It's your corner of the industry. What is competition like? How many robots go to your school? I know that sounds like a strange question. Just give viewers who are watching from the outside an idea of your world, Kenneth.
Actually, in our robot school, we totally have 150 robots to do different tasks in the different scenarios, and we collect different data. We also, our customers also, they want to define or they want to design their own scenarios, and we also can help our customers do this task. And during this process, we also use the teleoperation devices to control the robot, to collect each details and each data. And we think this is a good way, and this is maybe the quick way for now, because the model, we need to give some time to the robot, and we need to give some maybe more money to the robot for the trainings. So that is why we choose the teleoperation devices.
Kenneth, what do you think the goal is for training these robots in the school that you have, right? I'm guessing you can't just keep training hundreds of thousands of robots every time. We had a guest yesterday talking about developing a robot brain, for example. Is that sort of the goal for the industry in some ways, is to just download something that I can put on my robot? I don't have to keep training it in some ways? And how far away are we from that sort of reality?
Actually, for now, we don't think that the robot can do the whole job, right? So we will separate the each jobs. And for example, for the maybe simple or maybe for the easy task, we will teach the robot to do this. So we guess maybe after 1 year or 2 years, the robot can help us to do this standardized task. And for some highly risk decisions, the human will do this job. So that is why we train the robot. So we need step by steps to help to let the robot really help people to do some job in the real task.
This is something that we always look at when we look at these robot videos. Ken, maybe you can help us out. They're always a bit clumsy when it comes to doing these simple tasks, right? Whether it's making coffee, 包粽子, whatever, right? How do you work on the dexterity aspect of these robots? Just a curious question.
Yeah.
You mean how to let the robots do this job, right?
Yeah, how do you make it more precise and more human-like?
Oh, so that is why we choose we call the GLN, means the Global Link Network. That is the teleoperation devices with the same structure of the robot arms. And our controllers will control the robot arms of the devices, teleoperation devices. And when the people do the same actions, the robot will do the same actions. So that is why we choose this way, or why we use these devices to control the robot. because we think I always have a joke with our team that our teleoperation devices also have a mode that is the best mode, the human, which has been developed so many years. So when controllers do these actions, maybe the robot will also do these actions, and we can get each details or maybe each data of, for example, like the joint, like the camera, and as a whole the robot. So we will get data, and maybe in the future, when we get more data and to train the mode, and the robot can do this action by itself.
All right. We look forward to that. We can never get enough of these robot videos. No. Kenneth, it's great to have you. Kenneth Ren there, Director of Overseas Solutions at RealMan Robotics, joining us from our Beijing studios. Of course, we'll have more on robotics in the industry tomorrow as the World Robot Conference gets underway in Beijing. We'll be speaking to the head of Chinese embodied AI firm, Amoga Robotics. This is Bloomberg. All right, a big story that we're tracking here. Bloomberg has learned that investment firm HSG is in talks to raise $1.2 billion for an early-stage fund focused on the AI, healthcare, and consumer sectors. Now, for more context, HSG is an early backer of companies like Unitree, Minimax, and Moonshot AI.
Yeah, let's get more on the company formerly known as, you might know this, Sequoia China, with our managing editor for Asia Finance, Investing in Wealth, Lulu Chen. Okay, tell us more.
So HSG, formerly Sequoia China, they are in the market now talking with investors for several funds, including a $1.2 billion fund for early stage investments. Now they'll be looking into China mostly, but also looking for overseas investments. Key sectors include healthcare, tech, AI, and also consumer sectors. Now, this company, you might remember, they split from their U.S. counterparts a few years ago. So this is the first time that they're coming out and testing the waters to gauge interest for a U.S. dollar fund. A few years ago, they did raise $9 billion without the participation of their counterparts in the U.S. and Southeast Asia, and focused on investment solely for China at the time. Now they're coming back to the markets again. It's been a whirlwind of changes in the past few years. We've seen the up and downs in the tech sector, but now this year they're joining a slew of other investment firms, including IDG, Hill House, and also Primavera, coming to the market to gauge investor interest and appetite. They've done quite well in the past few years by marking a few tech companies, new AI newcomers like Minimax and also Moonshot. So there is interest in what they will be staking next.
Yeah, and you mentioned that they're also looking at maybe a growth fund, a yuan-denominated one as well. I mean, tell us a bit more of the fundraising environment now. I know you're saying there's a bit of momentum. Are we back to sort of the pre-crackdown sort of era? Do you think that we could get there?
So momentum, yes, because we're seeing quite a few companies that have managed to successfully raise funds, including Monolith, which has backed many AI companies, and now they're back in the market to raise another fund. But we're not quite back to heydays, but pre-crackdown days, 2021 levels. So, you know, what's really happening is LPs, many in the Middle East and also Southeast Asia are expressing interest in China. Some U.S. LPs, family offices are now looking. Many are on the fence still. The pensions, which is more politically sensitive, U.S. pensions might not be coming back. But then there's also, you know, this idea that China cannot be, like, investors cannot miss out on the China market because this is the only other market that is counterpart to the U.S. when it comes to the AI race.
All right, Lulu, thank you. Lulu Chen there, Bloomberg's managing editor for Asia Finance, Investing, and Wealth. Turning to Hong Kong now, really, where there's a lot of talk about what this whole kind of tax overhaul is going to look like, right? These proposed tax breaks for hedge funds are triggering a scramble across the city's financial industry.
Yep, you have family offices, you have banks, you have hedge funds are racing to determine, I think for the first question is who qualifies for these expanded exemptions, with some firms even warning that changes could make it harder, in fact, to retain talent and keep them here. Our finance reporter, Denise Wee, is here to talk us through the kinds of excitement, which is rare when you talk about a tax story, but there is some excitement here. Denise, what has it generated in Hong Kong? Give us the context here.
I think there's been a genuine interest in this carried interest tax break.
Yeah.
We're seeing funds that are genuinely interested in basing themselves here, making inquiries, getting set up, which is what the government wanted behind this tax break. But at the same time, we're seeing all these professionals suddenly scrambling to get a piece of the action. I mean, carried interest has typically been, reserved for the most senior executives. It's, a payout based on performance, a share of the profits. So suddenly we're seeing all these executives, seeing an opportunity to get a piece of the action and wanting to find out more.
Who is likely to qualify, and who isn't going to make the cut, you think?
So, I mean, the guidelines are not super prescriptive, but the government has sort of said in the bill that it's mainly it's focused on funds and they're managing third-party money. And also it's around the investment management professionals, so those that are, say, doing the fundraising, doing investment decisions. I mean, it's not that prescriptive, but generally that's who it's targeted at. Yeah. There was some speculation it might also include prop trading firms, but the government has said no, that's not going to be the case.
And what's the read-through to retaining talent?
Yeah, so I spoke to a headhunter who mentioned that, this is going to be a bit more of an issue for the banks because their prop traders will probably not qualify for this. And already the buy side has been quite attractive for these traders. So with this carried interest tax break, it's going to be even more attractive. And they're going to have to fight harder to retain their best traders.
Denise, thank you so much. Denise Wee, our finance reporter. You can check out that story, of course, also on the Bloomberg Terminal today. And also an insider's guide of the money and people shaking up the finance hub. That's a Hong Kong edition newsletter. It's Tuesday, so the new one is coming out in 2 days' time. Stay tuned for that one. If you're not subscribed yet, whip your phones out, and QR code is bottom of your screens. Check it out on Bloomberg.com, also /newsletters. This is Bloomberg.
We think that there is a scenario, at least in the second half, if, let's say, exports decelerates more notably, and then policymakers will probably be more seeing, at least a higher level of urgency in terms of rolling out more stepping up measures in policy easing. And we think it's very much warranted. We don't think this is necessarily structural. There is a big cyclical element in it, and policymakers need to do more.
Yeah, and that was Helen Qiao of BofA, who joined us about 45 minutes ago, right, for her take on the market. And she had a very different take from Wang, Shengzu, who joined us in the previous hour, in that he thought it was really more structural, and hence there's really little you think you could do, I think, when she said there's actually a very cyclical component here, and it might merit more action sooner.
Yeah, because when she mentioned, obviously it's still AI, it's still exports that continue to be the bright spots there. But as she says, right, some of the stuff, like any signs of that slowing down, I mean, there certainly is a lot of things that could put that whole story into question. So I think for her, there is this more urgency, maybe not as urgent as 2024 September for that, where we saw that policy pivot. But she says, anything in the form of fiscal spending, she says a lot of that has to do with why, the investment numbers have been so weak in the first half. Anything from, subsidies when it comes to consumer services, or even rate cuts, right, or triple R cuts, right? She says that's enough of a policy signal that could easily be send markets and get them excited again.
To change the behavior of economic agents to then, start investing themselves. Bond yields are tumbling, and this should be at session lows right now in the 10-year yield. We now have a 1.667 handle there on the Chinese 10-year yield. That's the bond markets. We'll leave you with a look at the benchmarks. We will see you all tomorrow. Thank you for joining us today. This is The China Show.